Futures are down after a couple of big data points. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, yields tumble after jobless claims rise more than expected, but traders are confounded by the inflation print.
And automakers are reeling from waning demand. BMW, Mercedes sales plunge in China as Stellantis eyes a management shakeup.
Plus, airline stocks slide in pre-market trading after Delta delivers a disappointing outlook. All of that and more coming up. But let's take a look at markets. 30 minutes until those bells ring. It doesn't look too pretty, of course, if you take a look at the main indexes. The S&P 500 down about 0.4%. The Nasdaq 100 also off by about 0.5%. Of course, inflation coming in a bit hotter. Claims were higher than expected, but of course, a lot of that can be chalked up to what's going on with those hurricanes. As such, you can see the bond market trying to figure out what to do. The 10-year yield currently camped out at around 407, Matt.
All right. Nonetheless, we did hit a 44th record high on the S&P yesterday. That has valuations soaring. You can see investors are paying 22 times next year's expected earnings, higher than any point since the beginning of the pandemic.
But now we are back to reality, are we not? So let's look at some stocks to watch under the surface as well. We're taking a look at Delta shares falling after the airline reported profit and sales forecasts that missed Wall Street estimates, ultimately suggesting a slow recovery from the summer travel challenges. Domino's also reported earnings, trimming its 2024 projections for sales growth. Slower consumer spending hit the restaurant industry here, and you're seeing it in Domino's. We're also watching Tesla as investors eagerly await the first look at the company's fully self-driving vehicle later today. Matt, you will be out of a driving job.
Yeah, I'm going to continue to operate the vehicle myself, but I will focus in on that news. Really right now, though, it's inflation and claims that are front and center, Katie. We saw inflation rise twice as quickly as we expected it to month over month.
Yep.
And the year over year level, it's the highest acceleration that we've seen in a year and a half for inflation. So maybe not quite under control.
You know, it's interesting to have these dueling 8:30 a.m. releases. Of course, claims it's noisy because of the hurricane, but still that was the biggest jump in initial jobless claims in 3 years. And we know that the Fed has to make policy with the economy that they have. And I mean, you take a look at the labor market, obviously feeling the pain right now, but you also have inflation hotter than expected.
Guys, can we just quickly also pull up the 2-year yield this morning? Because those dueling prints, the first headline drove yields higher because of that inflation print. Then you saw those jobless claims, and there might be a lot of noise in there, but take a look at it. You just saw the bond market really react to that so quickly there. And we're back to a story where clearly the chart shows you that traders don't know which direction to head.
Well, traders, no, I feel like you want to own that bet now
won.
if you think the Fed is going to cut in November. Let's get over to Mike McKee to ask him to interpret this for us. He's our chief international economics and policy correspondent. So, Mike, 258,000 jobless claims. That's a number I haven't seen in quite a long time. And inflation up to 3.3%. That's a number we haven't seen in a year and a half.
Yeah, the inflation is a little bit harder to figure out. The jobless claims, as you say, 258,000, but that's likely due to the hurricane and the people in Georgia, North Carolina, and Florida who were filing unemployment claims. We saw the unadjusted number go up by 53,000. So a significant number of people all at once filing claims. And when you look at the week prior, which is where the data comes from in terms of jobless claims, the states that had the fewest, the biggest drops in claims were Georgia, Florida, and North Carolina, and those are states where all those offices would have been closed. Now, the inflation numbers are interesting because what was going down went up, what was going up went down. Right. Other than energy and gasoline, which dropped a lot, we saw new cars, used cars go up in price. Food, which had been falling or flat for 7 months, goes up by 4/10. Food at home. So the grocery store is a problem. And you look here, this is the orange there is services. And the blue at the bottom is what I want you to notice there. It went above zero. Goods prices through food go up. And so that is really what pushed it up. Service prices, as you can see, have always been sort of higher, although shelter costs only up 3/10, which we hadn't seen in a very long time. And you wonder about the market. and what they're doing. You look at what swaps are showing right now for the November meeting, 85 basis points. In other words, less than one cut for November. Now, that's a residue and hangover from last Friday, but obviously maybe the CPI numbers feed into that fear, and people aren't sure that the Fed is going to cut. We get a lot of Fed speak over today, tomorrow, and next week, so watch that.
We certainly do, and of course we had the Fed minutes yesterday. And I do want to wrap that into the claims reading that we got, because we know it's very noisy, of course, with the hurricane. But going back to the Fed minutes, one of the passages in there was that many participants observed that the evaluation of labor market developments had been challenging, increased immigration, revisions to reported payroll data, possible changes in the underlying growth rate. Basically, you add it all together, it sounds like, it's getting harder and harder to get a feel for the labor market, even at the policy-making level. So, I have to ask, how much concern are you hearing about the quality of the labor market data that we have?
That question has been raised directly with some Fed officials that I've spoken with, and they basically said, we look at so many different things that we're not really worried about it. We're not just looking at the non-farm payrolls, we're looking at JOLTS, we're looking at jobless claims, although this will kind of get tossed out. They're looking at all of the regional PMIs, the national PMIs, ISM numbers, and they're putting together a kind of a overall look at it. Plus, they're always talking to CEOs and leaders. I was talking with some folks from ISM yesterday, and even though labor's been down in the manufacturing level, they say the companies aren't worried about it. They're just basically not hiring at this point, but they're not letting people go. They're still anticipating that the economy will rebound.
You saw that in the Fed minutes as well. Several participants emphasizing disaggregated data and also the checks that they do with their business contacts. Mike McKee, great to talk with you. Of course, that is Bloomberg's Mike McKee. And let's keep the conversation going now with Victoria Fernandez. She is Chief Market Strategist over at Crossmark Global Investments. And so you take a look at the reaction to the data that we got so far this morning. Of course, we had claims hotter than expected, inflation hotter than expected. So you add it all together, the reaction has been to sell stocks and buy the front end. Do you agree with that?
Well, I think it is kind of a warring of these two different elements. You had the Fed say, look, inflation is under control, so we're now going to focus on the labor market. And what we saw today is, well, perhaps that's not quite true. And we've been talking about that for months with our clients going, look, we still think you can see used car prices go up because they've been coming down. I know my car insurance continues to go up and my homeowner's insurance goes up. We saw food and apparel go up. So the goods component moved higher, and I think that's going to be concerning for the Fed. At the same time, you're looking at a labor market where perhaps it's not as strong as the payroll report last week led us to believe. I know we have hurricane numbers that are wrapped into this, but there's other elements that y'all were just talking about with Mike that say, hey, wait a minute, things maybe aren't so good. Temporary hiring is down. Labor differential is getting worse and worse. Cyclical employment is coming down. So I think that tells you the Fed has a very tough choice here. I would lean towards them either taking a pause in November if we continue to see data like we saw today, or only a 25 basis point cut. The probabilities of nothing happening at the November meeting were already up to 25% yesterday. We'll see where that ends up today, but it does give you a little room in the markets to maybe pick up some extra yield in that short end of the bond market.
Victoria, how much of a risk is there that we're going to be faced with a situation where the Fed has to both deal with sticky inflation as well as a weakening labor market? How does that play out? And do you think that that's a real risk moving forward?
Sonali, I think it is a risk. Look, we've been talking with our clients saying we don't want to stand in the way of the momentum that we've seen in the equity market. The trend is higher. You don't want to be on the opposite side of that, but you've got to be guarded because there are these risk elements that I think the Fed is going to start to pay attention to and not live up to the expectations the market priced in. It's part of the reason that we saw yields move higher the way they did. Typically, yields move higher after a first cut, so that's par for the course. But we've had a 50 basis point move in the 10-year Treasury. We've had almost an equivalent move in the 2-year. So that's telling us that there's still some concern there. We're not sure the Fed has everything under control the way that they want to, and that is a risk. The last thing the Fed wants to do is stoke those flames of inflation, have that move higher as we head into the end of the year, and have to actually raise rates again. I don't think there's, that's going to happen at the November or the December meeting if things continue the way they are, but it is a risk that's out there, along with the risk of a weakening labor market hurting the consumer.
Well, and why continue to cut? I mean, we talk about a weakening labor market because of this week's data, right? But the last jobs number was, a blowout, and we're running at 3%. We hit yet another record high on the S&P 500 yesterday. Spreads are at tights. I mean, this economy looks pretty darn strong, and equity investors are paying 22 times next year's earnings. Like, that's sky high, isn't it?
It is not. It is priced for perfection at 22 times. And we have obviously earnings really kicking off tomorrow with the banks. If earnings don't live up to the expectations that the market has, you can see that coming back pretty quickly, those valuations. Again, it's a reason we're staying guarded in this market. And yes, the economy is doing okay right now, but there are some yellow flags waving. I don't want to necessarily say red flags, but there are some yellow flags. And I think it's why the Fed does need to be cautious. You say, why cut it all? I think that should be part of their discussion. We saw in the minutes from the last meeting, not everyone was completely on board with the 50 basis point cut. I think you're going to see even more of that coming. There is this bifurcation going on in the market, and you see it on consumer spending. You see it on earnings. You see it on employment. You see it in production, in CapEx. Different parts of the market are doing okay, whereas other parts of the market are really suffering. I think that means the Fed needs to really take its time.
And just quickly, Victoria, put this into a portfolio. You mentioned that, you have some caution at this stage. Where does that lead you when you take a look, of course, at the sector level, at the industry level, about where you want to be right now?
Right. So obviously we want to be invested in the market. Like I said, you want to take advantage of the momentum that we're seeing there. But look at some of the new areas that have actually taken some leadership. Some of your industrials, financials are holding in because you see a yield curve that is steepening again. I think you can actually look at some of the staples or healthcare names, more of those defensive names that have come back over the last week. Pick up a little bit there, but I would add some fixed income allocation and some dividend income oriented allocations to your portfolio to buffer any equity market volatility that could come.
All right, so income through bonds and through dividends. Crossmark's Victoria Fernandez, always great to speak with you. Appreciate it. Meanwhile, let's take a check on these futures, of course. Less than 20 minutes until the bells ring, and we have a sea of red. You take a look at the S&P 500, the NASDAQ 100, both feeling the pinch, but in a big way, it's the small caps leading the decline. The Russell 2000 currently off by about 1%. Meanwhile, let's take a look under the hood right now. We'll do that with Abigail Doolittle.
Separate from the overall pressure that we have on stocks right now, Katie, we do have some stocks here under pressure for idiosyncratic reasons. Starting off with the shares of PayPal, down nearly 3%. This as Bernstein cuts shares to a market perform from an outperform, saying that the company's core button, that its pricing is more expensive than its competitors. So there could be competitive pressures in addition to interest rate concerns. We also have the shares of Pfizer lower. Two executives, former executives, have actually 10 times genomics, down 28%. And this as they put up a disappointing quarter, missing both earnings and revenue estimates. There is a 7% bear short interest. The stock on the year already down 63%. Sonali, it seems as though a lot of these DNA testing companies, they had a limited population of people who wanted to participate, and now tougher moves ahead. And then here's Pfizer, down more than 1%. Two former executives saying that they don't want to be a part of Starboard Value's turnaround efforts. Investors responding negatively, Sonali, to that news.
Abigail, thank you so much for keeping an eye on all of it for us. Now, coming up, we're going to talk about Hurricane Milton, moving off Florida's coast after cutting a path of destruction. We're going to bring you the latest. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. More than 3 million residents in Florida are without power after Hurricane Milton cut a destructive path across the state overnight. Airport operations are still impacted. Flooding emergencies remain in effect, and authorities are assessing the damage even as the heavy rains and searing winds continue to lash the region. The storm even ripped the roof off of the Tropicana Field Stadium, home of the Tampa Bay Rays. 7 & I will change its name to 7-Eleven, and the company is planning to split into two as part of an overhaul to fend off takeover advances from Couche-Tard. The Japanese retailer cut its operating profit outlook in its latest results. 7 & I's CEO said the plan was to speed up transformation as investors begin warming up to the Canadian company's $47 billion offer for the Japanese convenience store operator. And one of the greatest tennis players in history is calling it quits. Rafael Nadal announced he will be retiring at the end of the season. In a post on X. Nicknamed the King of Clay, the Spanish icon won a record 14 French Open titles alongside 8 other Grand Slams, including 5 U.S. Opens, as well as an Olympic gold medal. Nadal will play for Spain in his final match in the Davis Cup next month.
Now we're going to check back in on those shares of Delta. The airline's profit and sales forecast falling short of estimates, despite the CEO saying holiday travel demand looks very strong. Let's discuss it with Bloomberg's global aviation editor, Benedict Campbell. You look at what Campbell, sorry about that, Benedict. If you look at the kind of oversupply picture in the United States, I mean, how does Delta's earnings fall into this, and how does the outlook really pair with what analysts and other investors expect?
Yeah, so the oversupply picture has improved, actually. This is something that was more pronounced a couple of months ago when there was really a lot of capacity that was pumped into the market, and that really had an effect on prices that came down. That seems to be more under control now. In fact, September looked pretty good. We heard from Ed Bastian, the CEO of Delta, a short while ago, and he said that, you know, the business in September, both domestic and transatlantic, has turned positive. So that's on the good side. The issue is this is a stock that's actually done reasonably well so far this year. So sort of what your previous guest was saying, when you have shares that have done well and you have a sentiment out there that is positive, and then a company doesn't deliver right the way that people expected, they get punished. So there's a bit of a damper there on the stock today. There's nothing fundamentally wrong with the outlook. It's a little bit soft both on the earnings and on the sales side, but probably people were hoping for a little bit more, and that's what you get in the stock reaction.
Exactly. That's what priced for perfection means. Benny, they are still, though, having the issue that fares are dropping and wages are rising. It's an industry-wide issue, right? In terms of fares, when are these airlines going to get pricing power back, or what do they need to do to get some pricing power back?
Well, they are doing it already. They are taking that capacity out of the market. There was probably sort of over-exuberance in the market. The long sort of revenge travel period, that has come to an end, and now they are a lot more disciplined. So that will feed through to prices. We will see some positive improvement there. And again, the company said that Thanksgiving's looking good. The holiday season and Christmas, that's all looking good. On the other hand, you've got a bit of choppiness that's sort of baked into this. I thought it was interesting that he said the election will actually play a negative role. People don't like uncertainty, and they might travel less. And that's something that they can see in their forward bookings for October.
Well, that's where I wanted to go, because I can't imagine delaying a trip somewhere because of the election. Am I just not being creative enough, or does this sound like an excuse?
You never quite know. Sometimes companies are slightly creative when it comes to sort of explaining away their shortfalls. This could be one of them. We also don't have a very good comparison, because you have to remember last time we had an election in 2020, we had COVID. So again, any travel swings weren't as pronounced because basically people weren't traveling. And in 2016, maybe there wasn't as much uncertainty in terms of the result of the election, but the company claims that they have the data. It shows that indeed people are traveling less, they want to stay at home. And if we get clear results, maybe that will be just a flash in a pan and it'll disappear quickly. But if we enter a pronounced period of political uncertainty, then maybe people will think twice about what they want to spend, where they want to go. So that's something we'll have to watch.
All right, who knows? Remains to be seen. Benedict Campbell, really appreciate you talking about Delta earnings. Of course, Delta down about 1% pre-market. Now, coming up, Home Depot is requiring its corporate employees to do 8-hour shifts at its retail stores. We'll have the details in Social Climbers next. This is Bloomberg. All right, it's time now for Social Climbers. Companies making waves this morning. And first up, we have Amazon adding Apple's TV Plus streaming service to its channels, offering hits such as Ted Lasso in its video supermarket for the first time. Meanwhile, Apple will start selling TV Plus subscriptions through Prime later this month. Next up, Walt Disney increasing ticket prices for its 2 Southern California theme parks by about 6% on most days, effective immediately. That pushes the highest cost for a single day ticket over $200 for the first time. And finally, Home Depot will begin requiring corporate employees to work a full day at one of its stores every single quarter. The DIY home improvement retailer says that the move is aimed at supporting its retail staff. Meanwhile, let's take a check on these markets, of course. You can see that it's not too pretty of a picture. The S&P 500 currently off by about 0.3%, a little bit more if you take a look at big tech, off by about 0.5%, of course, after that hotter than expected CPI reading. But of course, it's hitting the smallest companies the hardest. You have the Russell 2000 currently off by about 1%. We'll see how that market opens in just about 4 minutes until the opening bell. We'll, of course, discuss that and bring you through it all. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. It appears today that bad news is bad news for the equity markets. You can see S&P futures down 0.3%, NASDAQ futures off 0.5% after inflation came in hotter than expected and initial jobless claims came in bigger than expected. The opening bells ringing down at the New York Stock Exchange as well as the NASDAQ marketplace. We've got a charity fundraiser here at the New York Stock Exchange. Look at Pete. Great to see those guys. And down at the NASDAQ marketplace, you've got Intelligent Alpha ringing the bell. So let's take a look at what's going on after those 2 big data points came in. Obviously, markets are lower, but Katie Greifeld is here to tell us exactly how much in the first 30 seconds of trading. Katie?
Yeah, Matt, we had our 44th record close yesterday for the S&P 500, at least as it stands right now. Of course, 30 seconds into the trading day, we're not going to get there. Currently off by about 0.3% if you take a look at the S&P 500. A little bit worse if you take a look at the NASDAQ 100. Your big tech names currently off by about 0.5% after that hot inflation, and even more so if you take a look at your small caps. The Russell 2000 currently lower by about 1%. Meanwhile, let's take a look under the hood. We've been talking about Delta's outlook, which disappointed Wall Street, despite CEO Ed Bastian saying that demand for holiday travel looks strong. He also said that he expects some uncertainty and weakness around the election. I don't know if I quite buy that, Sonali, but stock currently up about 0.5%.
You also have Domino's, Katie, taking a little bit of a lift pre-market in the market open. Sorry, up more than 1%. Interesting. That's even as Domino's expects annual global sales growth below its long-term target of 7% or more. It also cut its outlook for net store openings through the end of the year. Pizzaflation, Matt. Not a good joke? Okay.
I like it. You know what I was thinking? You know, back in the day, a couple of guys paid 10,000 Bitcoin for 2 pizzas.
Yes.
Which would be worth about $60 billion.
Is that the worst trade ever? I don't know.
Yeah. It has to be up there with the worst trades ever. All right, today, Tesla will unveil its fully self-driving vehicle. Shares are up about 70% since April, when Musk pivoted the company to a focus on AI. More on that in a moment, but We continue to see record after record close for the S&P 500 this year, 44 to be exact. Let's take a closer look with Bloomberg's Abigail Doolittle. Abby?
Yeah, we may have losses on the day, but we do have big gains on the year. And in fact, sector-wise for the S&P 500 coming into today, 44 record highs, as Katie was talking about. Lots of stocks trading higher, including Vistra and NVIDIA. But from a sector perspective, you can see technology up 32%, communications up about 28%, and then utilities up 24%. And what makes this really interesting is the fact that, of course, utilities, because of the AI craze, getting this big boost. On bottom, real estate, but still up a healthy 8%, energy up 10.1%. So again, a very strong year. Now, relative to some of those big movers on the year, if we take a look at what's happening here, Vistra, that is the top stock, up 222%. Again, a utility company, of course, benefiting from the fact that yields are lower, so those dividends look more attractive. But it also, again, has to do with the idea of boosting AI, the craze, the demand, boosting utilities, energy use, that helping also, of course, NVIDIA. That would have been the stock one that many people probably would think was the top stock on the year, up a very healthy 166%, recovering off of those lows. Palantir and Constellation Energy are some of the other big stocks. Now, if we put all this into perspective, Katie, and take a look at the record highs in the S&P 500, here is the big gain over a long time period, going all the way back to 1960. It really puts into perspective the tech bubble and then the housing crisis bubble, really smoothed out here on this chart. But take a look at the record highs, up 44 right now. The next biggest is back in 2021, where we had 70, and then 1995, 77. So I don't believe mathematically, no, I guess we can. Mathematically, I think we can still get to both of those. Let's see how the year rounds out.
All right, you gotta believe. Abigail Doolittle, thank you so much. Meanwhile, let's broaden out this conversation with Jose Rasco. He is CIO for the Americas at HSBC Private Banking and Wealth Management. Great to see you on set with us.
Thank you. Thank you for having me.
So I want to get to earnings. Of course, we're on the cusp of earnings with the big banks setting the stage. But I want to first talk about the data that we got this morning. Of course, the claims data was noisy, but we did see a weakening labor market, and we saw hotter than expected CPI. You think about how much of this rally has been fueled by the Federal Reserve and its easing trajectory. How big of a fly in the ointment is this?
I mean, clearly the rhetoric's going to go from stagflation to soft landing to no landing, and now we're going to have an overheating economy story percolating through the markets. I think it's a bit of a tempest in a teapot. The direction for the CPI is still downward from our perspective. 2% target means a symmetric rate 1.5 to 2.5, and I think we're still in that range. It's not going to be a straight line to the bottom. Yes. Now, we have concerns. Energy, for example. I mean, Abigail just talked about the demand for energy. If you look at independent power producers, that subsector has soared in the last 60 days, right? And valuations still look great. So we think there are pockets of this that still make sense from the energy matrix, but in looking at an inflation accelerating story doesn't make sense. So from an earnings perspective, we like the market.
But more on the S word, stagflation.
Yeah.
How do you think the market is really accounting for the risks that that's what we might see?
We think that's de minimis. I mean, we actually think, I would say, let's continue the airline or airport metaphor here. Rather than a soft landing or no landing, let's call it a touch and go landing, right? And so we think we're going to see the economy slow. But remember, it's not just the cyclical story. It is also the secular. If Abigail talked about the greatest year we've seen since this year, before this year, 2021, in terms of all-time highs. What was happening in 2021? Fed funds were going down. We think we're going to see the same this year into next year. That's very accretive to earnings. And if you have stable inflation, which means it's in a range, right? Not flat, but in a range, and you have good growth, that's positive for equities.
Right. I think the employment data doesn't seem noisy to me. It's loud and clear that the big boost came out of North Carolina and Florida. I get what you mean by that.
You just saw the headline. You have to click into
true.
eCan Go on your terminal.
That's what I wanted to bring. So Michael
ECAN.
McDonough sent over an eCan screen. This is a fantastic function on the Bloomberg.
It's like on your speed dial.
He is. I follow him. You can follow people on the Bloomberg terminal. So I follow Michael. Check this out. You can see it. Well, I would make it a little bit smaller in terms of the range. Like, look at it for 6 months. Yeah. And if you can click on that in the control room, there you go.
Right, loading.
You can see the blue here and the red. North Carolina and Florida grew substantially after the hurricane, obviously. So my point is the labor market looks pretty healthy, right? Corporate earnings look pretty healthy. Asset prices look pretty healthy. And inflation really is climbing back up. So why aren't you worried about...
I would argue that point.
So we've seen the biggest climb year over year in a year and a half, right? I mean...
Talking about like 0.1%, though, right?
No, 3.3%. We haven't seen 3.3%.
Yeah, but from 3.2. Yeah. I mean, so that's number one. Number two, companies are more profitable. If you look at the FactSet did a great study where they looked at second quarter earnings. 40% of companies in the first half of the year, both first and second quarter, said AI was contributing to lower costs and raise revenue. That's profitability, Matt. So I think that's what we're focused on. It's a growth story. And don't focus just on the cyclical. We have tried to incorporate the secular themes of nearshoring, reindustrialization of the U.S., the tech revolution, innovation in healthcare. Look at AI in healthcare. Look at all the things going on in terms of billing and bed costs and all this for hospitals, the insurance business. What's happening here is truly revolutionary. And it's not going to make major headlines, but you're going to see costs, COGS, the cost of goods sold, right? That is going to be controlled, and you're going to see new revenue opportunities pop up. So we're still, I hear what you're saying. There is the risk of inflation, but in a slowing economy, that's hard. Remember,
by the way, do you worry about if Donald Trump wins and we, mass deportations, 10, 15 million out of the labor force, right? 60% tariffs on everything from China, so a huge spike in prices. Taxes continue to be cut. I'm not complaining about that, but it's inflationary, right?
Did you buy gold or something?
No, I'm just wondering, are you concerned about that? And especially if then we start breaking up our own national champions like Google, like it doesn't look good.
You can't. Well, that's not a Trump thing. That's a congressional thing, right? Right. What's going on with tech and breaking up of monopoly power and all that. That's going to be there regardless of who's in the White House, right? But I think if you look at that reflation trade story, you have to also factor in one thing, which is the secular theme of tech deflation is not yet factored in fully into the market. I don't think. And that is still to come. And we saw this in the 90s.
Right.
And in the 90s, everybody talked about, well, the economy's reaccelerating, Fed is cutting rates. Oh, my God, inflation. And all of a sudden, wait a minute. And I don't know about you, I'm an insomniac. I watch late night TV, and some of it's pretty bad, right? So you guys should be on late night. But if you watch late night TV, there's discounting all over the place.
I think we're more made for late night, for what it's worth.
Well, before we let you go, and not to agree with Matt too much here, but let's talk about valuations, because you've made the point that you take a look at valuations on this S&P 500. They're pretty high right now, highest since the pandemic. How much do you factor in valuations when you take a look at this upcoming earnings season? Because many people have made the point to us that we're pretty much priced for perfection right now.
You could make that argument. But if you look, we've looked at bull markets, we've looked at economic cycles, and we've also looked at valuation cycles. And if you look at valuation cycles for the S&P and for the tech sector, this is middle of the road. This is not excessive. It is not cheap, but it is not excessive. We are not at the point where you should be waving the white flag and saying, everybody back up the truck and sell. We're nowhere near that. And the good news is in this cycle, as opposed to 94, 95, in 94, 95, multiples soared because companies were priced high and they made no money. Today, those companies that have good value, you should see tech valuations soar meaningfully for the broader tech market, and that's what's coming. That's what gives us a broader market.
So the fundamentals justify the valuations.
I mean, they're not cheap, but look around the world. Where are you going to put your money? We do this every day, and every day everybody complains to me about valuations in the U.S. market, and I go, okay, great. Where are we going to put it?
Well, we start tomorrow, don't we, with J.P. Morgan trading at 2 times its book value. Matthew, let's see if that valuation is justified. We'll set off the rest of the market. Jose Rasco, we thank you so very much, of HSBC Private Banking and Wealth Management. Now coming up, the CEO of Stellantis planning a big management shakeup amid profit concerns. More on the latest auto news next. This is Bloomberg.
All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up, Truist upgrading Nike to a buy. The firm says that the sportswear giant is moving in the right direction with the return of company veterans, including Elliott Hill as CEO. He starts on Monday. Next up, CFRA says that Lululemon no longer a buy, downgrading the company to a hold. Analysts over there say that shares are due for consolidation. And finally, we have JP Morgan raising AIG to a buy. The analyst says that the bullish view on the stock reflects its outsized EPS growth and attractive valuation, Matt.
All right, interesting stuff there. I want to get to cars. The board at Stellantis is meeting to discuss the future of CEO Carlos Tavares this week. It comes as Tavares is planning, reportedly, a sweeping management shakeup in response to the company's disastrous profit warning. This, according to a source. Let's discuss with Bloomberg's auto czar, Craig Trudell. He sits in London. And Craig, you know, I was looking at the shares of Stellantis. They had been winning in terms of, you know, all of the incumbent automakers this year, and now they are the biggest loser, dropping 55% peak to trough. What can Tavares do?
Yeah, this has really been a stunning few months for this company, because I think, you know, up to even, you know, early this year, it was really, you know, an automaker that was firing, right? And you know, the reputation of Tavares was as, you know, a real sort of, you know, executor, the ability to combine these two companies, as he was able to, you know, say combine Opel when he was running PSA. So, you know, he has, unfortunately, I think, you know, for skeptics of this company, you know, sort of resorted to more cutting in the face of, you know, signs that maybe what this company actually needs is product, right? And so can he build, can he prove himself as a product guy more so than just, you know, an operator? And I think that's the big sort of open question here.
And just to focus on the palace intrigue for a little bit longer, what about Tavares's own future? Because, of course, you've reported that board members are also expected to discuss his future during the two-day meeting. Of course, Bloomberg has reported that the chairman has started looking for a successor to Tavares, whose contract ends in early 2026. Is it possible that he goes before then?
I think it's unlikely that we would see him get the push, especially just at this juncture. I think, you know, one of the things that makes Stellantis so fascinating is it's kind of like running the UN in the sense that, you know, you have, you know, very, very strong interests of the Italians, of the French, of the Americans. It's a company that is really complex, and this is going to be a really difficult succession search if you're John Elkann. And so, you know, whether or not they you know, would be able to quickly sort of pivot to a new leader when they have Tavares under contract for a good while longer now, I think it would be a real shock and would not necessarily inspire a whole lot of confidence in the company at a time when, you know, morale is already quite low.
I wonder about General Motors. I was looking at the fact that that company's stock has dominated automakers. It's the only one of the big incumbents that hasn't fallen this year. It's doing very well. However, General Motors and Ford have the lowest valuations in terms of enterprise value to operating profit of any company on the S&P 500, and there are 503 companies on that index. Our own Joel Levington from Bloomberg Intelligence makes the argument that they have enough cash left over to buy 40% of their shares. Is it potential that we see a share buyback coming from GM?
Well, I think that's actually part of what's driven such a strong year for Mary Barra, is the fact that, you know, around this time last year, this was a company that was really struggling with its investments in electric vehicles and robo-taxis. We had a really ugly incident with Cruise, their self-driving vehicle unit, and she really made a sort of, you know, huge decision late in 2023 to put off some of the electric vehicle projects that they had, you know, both vehicles themselves and batteries that went into them. She's really made some dramatic moves in bringing in new leadership of the battery business, and she's, you know, taken quite a bit of money off the table for Cruise to go through and really sort of honed in on what this company, you know, does best, which is make big pickups and SUVs that, you know, they make a lot of money off of. And in the meantime, they were going to buy back shares and really, you know, do a significant amount of returning to shareholders. And that really kind of touched off a bit of a trend in the industry where others had to follow suit. I do think that Joel's analysis is spot on, that there may be more to buy in you know, the near future.
All right, Craig, unfortunately, we got to leave it there. Really appreciate your reporting. That is Bloomberg car czar, Craig Trudell. Now, coming up, FTC Chair Lina Khan says that there's a lot more work left to do, even as major Democratic donors call for her ouster. That's next in our Wall Street Beat. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's take a check on stocks. About 20 minutes into the U.S. trading day, you can see we're still down, of course, 44 record closes as of yesterday now. Taking a bit of a breather after that hot CPI. The S&P 500 off 0.3%, and it gets worse as you go down. The Nasdaq 100 off about 0.6%. Those small caps, Sonali, off by 1.3%.
It's time now, Katie, for the Wall Street Beat. We're going to talk about a highly watched person in Washington, Lina Khan. She's been chair of the FTC for 3 years, and in that time, she's toughened merger oversight, taken on non-competes, and she's driven the donor class crazy by hitting their pocketbooks. She hints that there's more to come if she gets another term, and Khan is the subject of today's big take. Bloomberg Business Week's Mac Chafkin co-wrote the story, joins us now, curious about this, because yes, there are clearly large billionaire donors that are very frustrated with her. More and more under the surface, though, I've heard a couple people on Wall Street even say that that criticism is even too harsh. I'm wondering if it's because they think that's just the reality.
Well, Lina Khan is an interesting figure because she sort of cuts across partisan divides. You know, she's very popular with members of the squad. You know, AOC is a big Lina Khan fan. A bunch of the progressive Democrats are. You also see in certain industries, industries that are concerned about certain kinds of consolidations, they like her. And also on the Republican side, you know, J.D. Vance, some of these kind of new right figures, the younger, very conservative figures, also like Lina Khan. So she's an interesting case because in certain ways she shows the way that the kind of like traditional kind of corporate consensus has kind of lost some purchase in Washington on both sides of the aisle.
So you mentioned AOC. Let's take this to social media. Of course, she posted on X yesterday, anyone goes near Lina Khan and there will be an out-and-out brawl. And that is a promise. She proves this admin fights for working people. It would be terrible leadership to remove her. That's a direct quote. Pretty powerful language there, I would say, but it sort of speaks to what you were saying, the depth of the support that Lina Khan has with certain members of Congress.
Yes, responding to Mark Cuban, I believe, who also made some comments to us for this story. He is kind of a mixed take on Lina Khan, but like many people who are connected to the tech industry, feels like she's really hurt kind of the market for M&A. He's worried about AI, overregulation of AI, and AOC, of course, promising, you know, not to go down easy.
Well, to that end, too, the reason Mark Cuban likes her is because of the pharmacy benefit managers. That's his business that he's after. She's after it in a big way. Does she help little tech in any way? How does the tech industry feel about her?
So there are questions. I mean, I think there are questions about how significant little tech is, but there is, as you say, Sonali, a movement among a handful of investors, most notably Y Combinator and Andreessen Horowitz, to sort of point out that Google, Amazon, Apple, they are making it harder for certain kinds of businesses to get off the ground. And this group, especially led by the kind of Y Combinator folks and a handful of others, are basically saying this is great. We need to rein in Google. We need to rein in Apple. We need to rein in Amazon. And so they are celebrating Lina Khan and attempting, I think, to create a little bit of momentum on the other side so that it isn't just a bunch of rich guys yelling at her, some supporting her.
Max, great to have you on the program. Recommend everybody read your big take on the Bloomberg terminal or on Bloomberg.com. Max Chafkin there from Bloomberg Business Week. Now, coming up in the next hour, Nouriel Roubini joins us to talk about the economy and give us his thoughts as well on 20-year Treasury bills. We're going to talk about the activist Treasury issuance theory. Then, KBW's CEO joins us ahead of bank earnings tomorrow. This could be the big one, folks. This is Bloomberg. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, the world according to Nouriel Roubini, the top economist with a track record of predicting doom, joins us to talk the economy and the election and what else is keeping him up at night.
JP Morgan and Wells Fargo kick off bank earnings tomorrow in a new era of rate cuts. We'll get a preview from KBW CEO Michaud.
And the latest from the campaign trail, Donald Trump vows to eliminate income taxes for Americans living abroad. All that and more coming up. But as Matt mentioned, we are 30 minutes into the trading day, and you can see not too pretty, but not too bad. The S&P 500 currently off about 0.3% from all-time highs, which we hit yesterday. Same story, too, if you take a look at the NASDAQ 100, your big tech index currently off about 0.4%. Meanwhile, all quiet in the bond market, at least when you look further out the curve. The 10-year Treasury yield, I'm going to go ahead and call that unchanged, even though we did see some fireworks after we got all that 8:30 a.m. data.
Now let's turn to the economic impact of geopolitical risks and political risks. One of the biggest challenges on the horizon, according to our next guest, is stagflationary shocks if Donald Trump returns to the White House. Nouriel Roubini, the CEO of Roubini Macro Associates, earned the nickname Dr. Doom for his predictions of the global financial crisis. He joins us now on the latest warning. You know, this idea of
it happened. We got the global financial crisis.
We certainly did have that. Yes.
It was a correct prediction.
So the next prediction, when you think about Donald Trump, what exactly is the message here? Is he or Kamala Harris better for the economy? Which is worse, in your view?
Well, their economic policies are going to be very different. If you take at face value what Donald Trump says, he says, I'm going to impose tariffs of 10% to up to 20% on all imports in the United States. He wants to impose tariffs up to 60% on China. He wants to weaken the value of the dollar because he thinks it's overvalued and is leading to deindustrialization. He wants a looser monetary and credit policy. And the Center for Responsible Budget just 2 days ago said that this fiscal policy, including making permanent all the tax cuts, are going to cost us another $7.5 trillion over the next decade. Those of Harris, 3.5. Both of them larger deficit, but certainly much larger. On top of it, he wants to restrict migration, and we know that migration in the U.S. has kept a limit on wage growth and has increased the supply of labor and maintained growth above average. So the combination of all these policies, currency, tariff, monetary, fiscal, and immigration, implies somehow higher inflation and somehow lower economic growth. In that sense, they would be stagflationary.
When I listen to his defense or Jason Trenner, Joe Livornia defending his policies, they say, look.
Scott Bessent, John Paulson.
Exactly. And there's a pretty long list. And they say, look, first of all, don't take what he says at face value, right? Which I guess is a little bit difficult. But they do say that if you drive up those tariffs, you'll have more onshoring of manufacturing, right? Also, if you get tax cuts, there's kind of a Laffer curve argument that we'll take that money that we didn't give to Uncle Sam and spend it out into the economy. They're basically saying they're going to push growth. Why don't you buy that?
Well, I don't buy that because, first of all, if you're going to impose tariffs, increases inflation. And if you're not going to import the goods from China because there are 60% tariffs, low value added or even medium value added labor intensive goods are going to go to Vietnam, they're going to go to Bangladesh, they're going to go to Turkey, to Mexico. The idea we're going to reshore low value added manufacturing in the US just doesn't make any sense. So it'll be just a transfer from China to somewhere else. It's true that he's making the argument that making the tax cuts permanent are going to help economic growth. He wants to massively deregulate the economy, and he wants actually to move away from a green transition to phasing out those IRA subsidies and going back to massive increases in fossil fuel production. He says 3 million barrels a day of more production over the next 4 years. But the reality is that deregulation doesn't have a very large impact on economic growth, maybe 5-10 basis points, but not more than that. We know that tariffs have a negative impact, especially if there's going to be a trade war. Harris wants to increase the corporate tax rate from 21 to 28%, but if it keeps it at 21 and we have budget deficits of an additional 7.4 trillion, bond yields are going to be higher, and that's going to crowd out economic growth. In some way, we have to start finding ways of either spending less or raising taxes. At least Harris has some ways of doing that. So they're crowding out coming from lower tax rates is another important thing. So there are arguments he makes on why his policies are going to be pro-growth and lower inflation, but actually on net, if you take them together, currency, trade, immigration, monetary and fiscal, they would increase bond yields, they would reduce growth, and would increase inflation.
Right. Well, let's build on that because, of course, when you lay out the Trump scenario, a Trump win, of course, you told Bloomberg News that you would recommend holding gold, short-term duration bonds, and tips as well. When you think about the potential Harris policies, and, of course, the polls are on a knife's edge right now, how different is the portfolio that you would structure?
Well, I would say that certainly if Trump were to be elected and inflation is going to be somehow higher, bond yields are going to be higher also because deficits will be higher, and you don't want to be in long duration fixed income. Both in 2021, 22, we saw when bond yields went higher, the price fell. You lost more money on 10-year Treasury in 22 than on S&P 500. Same thing happened last year in August, September. So in a world where bond yields are higher, you want to be away from long-duration fixed income. If you want still to maintain a defensive asset, it's not anymore long-duration bonds, but things that are going to be resilient to inflation, to the basement of fiat currency, to the dollarization, and that's where short-term treasuries, tips and gold, and maybe some overexposure to some key commodity might be the right way to go. Now, if Harris were to be elected, the economic implication will be somehow different. I worry that regardless of Harris or Trump, that over the medium term, we have a number of negative aggregate supply shocks that are meaningful. Deglobalization, reshoring, friendshoring, aging, restriction of migration, geopolitical conflict, climate change, pandemics, backlash against the liberal democracy. All these things tend to increase cost of production, reduce growth, and there are stagflation of the medium term. So some of my arguments are independent of whether Harris or Trump will be elected. It's a more medium-term argument why stagflationary pressure are going to be with us over the medium term.
Stagflation is certainly a word that keeps coming up a little more. You also mentioned commodities selectively. I'm curious about your view on oil prices here, particularly with the conflict that we're seeing in the Middle East on the verge of an escalation. We have seen Brent hit above 80 this week. Where do you think it goes?
Well, I think it all depends on how much Israel is going to strike Iran and whether the conflict is going to remain contained or is going to escalate into a full conflict. And again, whether it's Trump or Harris is going to make a big difference because right now Israel is not just Netanyahu. Even leaders of the opposition like Benny Gantz have made an article this week saying we should go after Iran. So there's a consensus after Israeli society that all these proxies of Iran have created trouble for Israel. Hamas, Hezbollah, the Houthis, the Syrian and the Iraqi militias are trouble. So you have to go to the head of the problem. So Israelis are moving in the direction of striking Iran big time. If Harris is elected, she's going to tell them, do it selectively. Trump has told them, if you go after the nuclear facilities, you have my approval. They're going to maybe try to go after regime change, even decapitate some of the leaders. If that were to happen, you'll have a situation in which the Iranians can mine the Gulf, they can strike the pipelines and the oil facilities of Saudi and the Emeritus, and then you're going to have a shock to the production and export of oil from the Gulf. I'm old enough to remember 1973 Yom Kippur War between Israel and Arab states, or 1979 Islamic Iranian Revolution, where you had a tripling of oil prices, you had a shock to growth and exports of oil, and you had a global recession and stagflation. So I would say of the biggest risk out there, the one that is not yet priced in by the market is a risk of a strike by Israel and a war with Iran, with spike in oil prices and global stagflation.
First of all, you're barely old enough to remember that, right? I mean, maybe you were
66.
So you were 13 in 73.
But I remember that.
So these are all.
I really remember. I was in a synagogue during Yom Kippur, and the war started. So
these are all vivid. Very big picture. Discussions over a number of years, and it's fascinating. But what if you look at what's happening right now in the U.S. economy and how the Fed is reacting? What's your interpretation of, for example, the inflation that we're getting right now, 3.3%, the unemployment picture at 4%, growth at 3%, as the Fed is cutting from 5.5%? It seems to be
like their reaction function is completely independent from some of these other forces that could create inflation.
So it has to be, right?
I mean, my interpretation is that actually, in spite of the Fed going until recently to 5.5, growth has remained above potential and inflation fell sharply. Was it monetary policy? Only partially. It was that there were 3 negative aggregate supply shocks during COVID that now reversed the impact of COVID on the supply of labor, production of goods and services, and global supply chains, then the shock coming from Russia, Ukraine on commodity prices, and the zero COVID policy of China. Those things have gone away. and they've now increased growth and reduced inflation. On top of it, we also got lucky for two other reasons. One, the AI revolution that's led to a boom in capex. Two, the migration policy of the Biden administration implied 2.5 million people entering the U.S., documented or otherwise, every year for the last 4 years. That has been a significant increase in the labor supply, has increased economic growth, has reduced wage inflation, and that's another force. So we are in this paradox that growth has remained above potential. Second quarter, 3%. The third quarter is estimated by the nowcast to be 3.2%. And inflation is still slightly above the target, but is falling. And the fact that it's actually not falling as much is a signal that economic growth is actually not even a soft landing scenario, but maybe in a no landing scenario where growth is going to remain above potential, and therefore pressures on the labor market are going to remain sustained. Wage growth is still around 4%. That's not consistent with inflation at 2%. So we are closer to a no landing rather than a soft landing scenario.
And Nouriel, we're lucky to have you for 2 blocks. But before we go to break, I do want to talk about the equity market, because you told Bloomberg News this week that big tech is a story that, in my view, is valid in the sense that AI is going to radically change the world, starting with the U.S. You also make the point it's not going to happen overnight. But even still, I've heard almost word for word that exact same argument made by pretty big stock bulls. You don't necessarily fall into that camp, though.
No, if I look at the medium long term, I spoke about the stagflationary forces in the world, but there's one that actually is disinflationary in a positive way. That implies more growth and lower inflation. And it's not just Gen AI, but I think people are obsessing too much about Gen AI. There is going to be a revolution in robotic and automation, in biomedical research to make us live healthier and longer. There's quantum computing and the merger with AI. There is space exploration and exploitation, green tech, ag tech, mobility revolution, financial services, in my view, not crypto, but rather the non-fintech part of it. And there are all these new technologies, and they're going to all lead over time to higher potential growth and lower inflation over the next decade. Therefore, I think that the stock market is reflecting not just the Gen AI, but the fact that there is a wide range, maybe 10 different industries of the future. And in almost all of them, with the exception maybe of the mobility revolution, the US is ahead of China.
So
let alone ahead of Europe and everybody else.
When would you buy stocks then? When would you invest along that view?
Well, the stock market is going to higher based on this expectation of higher economic growth. My view is that I wrote a piece recently saying artificial intelligence versus human stupidity, arguing that artificial intelligence is going to create more potential growth, which would imply more economic growth, lower inflation, and higher earning in the stock market. But we have all these other mega threats that I discussed that over the next few years are going to reduce growth and increase inflation. So you have stagflationary forces on one side, and others are going to be positive, and it's going to be which one of them over which horizon is going to be stronger.
Just really quickly here, because we're running up against the clock, and because you're Dr. Dune, I feel like you'll give me a direct answer on this. If you have artificial intelligence impacting the job market, at what point do you have a significant impact from AI on jobs?
It's not going to be overnight, of course. If anything, actually, we have a lack of labor supply, and restrictive migration policies are going to be problematic for economic growth. But I would say that over time, both white-collar jobs and blue-collar jobs, initially low value added, increasingly medium value added, are going to be challenged by the AI revolution. You know, people said initially the jobs are going to be gone, will be more white-collar because AI is software, while for replacing humans, you need essentially machines and the integration between hardware and software. But now, in the last few quarters, there's been a revolution in the humanoid robots research, and in a matter of a year or two, there'll be literally robots that are learning by following actual factory worker, everything that the factory worker can do, following construction workers and doing exactly what the construction worker do, or can follow a housekeeper who cooks and cleans and do the same. So 2 years from now, we'll have robots that are going to replace a significant number of factory jobs or construction jobs or other service jobs. So I think they will be surprised on how fast this technology is going to radically change even the labor market. It's going to happen sooner than we expect.
All right, Nouriel, believe it or not, we are just getting started, so stick with us. That is Nouriel Roubini. And coming up next, the raging debate over activist treasury issuance, a debate started by Nouriel Roubini. This is Bloomberg.
It's the moment we have all been waiting for, or at least I have. That is bank earnings. JP Morgan and Wells Fargo kick off the first bank earnings season since the Fed's rate cut last month. The largest U.S. lenders have benefited from years of rising interest rates. KBW, which provides research on banks, covers more than 200 banks, expects earnings in the banking industry to fall 7% year over year. Here now is Tom Michaud, the CEO of KBW, a Stifel company. You know, let's just start with the biggest of the big. JP Morgan is such a bellwether. It's trading at almost 2 times its book value. I believe that's the highest it's really ever traded. Is that too much? Is it priced to perfection?
So I think there are a couple of different layers to the JP Morgan story. First of all, the company's doing really well. It's going to earn, we think, around 17% on tangible common equity, which by any measure is really good. We have not been recommending the stock because we think that its superior performance has been reflected in the stock. Doesn't mean maybe long term it isn't a good investment, but it's not where we think the action's going to be possibly tomorrow. From a stock perspective, we think the action actually is more in the Bank of New York, which very quietly we think has really geared up performance.
And we'll get to that, but I do want to meditate on valuations a little bit longer because that stat that Sonali brought up, JP Morgan 2 times book value, you read in your notes that you take a look at the group overall, still 15% undervalued relative to recent history. I mean, I read that, I have to think there's some dispersion there within it. So, I mean, how are the JP Morgans of the world faring relative to everyone else when it comes to how the market is valuing?
So in the near term, the more of a spread lender you are, meaning you don't have an investment bank, even though we think there is an improvement coming in investment banking, the more of a spread lender you are, the more of marginal improvement you're going to get. So we just went through the longest period in 47 years of an inverted yield curve. That period is now over. It's still flat, but it's not as bad as it was. So we think you're going to see, so put it this way. In 2024, 72% of the banks we follow are going to have down earnings per share. In 2026, we think 52% of the banks we follow are going to have double-digit earnings per share growth. We're coming out of this period, and you're about to get revenue momentum because the yield curve has stopped being so penalizing. And so I think we're going to go through a period of improving earnings per share. Book value this quarter alone, tangible book, is going to be up 5%. Comerica and Fifth Third, our 2 companies we follow, are going to grow book value by 20% this quarter. So, and then you look at the Bank of New York, they're going to return 110% of retained earnings back to shareholders in buyback and dividends. So the story is getting better, probably slowly, and we need a soft landing to make it all happen. Hard landing, we'll come back and talk about what changes. But soft landing, I think the industry is positioned for more fundamental good news, which I think will help the companies that are best positioned for that.
So making money on that spread, though, requires continued lending, right? Loan growth has been weak, and defaults have been increasing. How do you see the U.S. consumer doing in terms of bank servicing?
So if I had a crystal ball and I could get an answer to one question about our forecast, it's hard landing, soft landing. So the industry is still over-earning on credit. Pre-global financial crisis, so we'll go back to pre-2008, the industry had a 60 basis point loss rate over the cycle. Right now, we're forecasting 26 basis points. Now, maybe the industry is less risky, but we are still over-earning on credit, and that could change the outlook. And I think, like you asked, it all starts with the consumer. We're forecasting mid-4% unemployment. Unemployment goes a lot higher than that. We got to review it. But really what you need is less bad. I mean, it's not like you need overwhelming. Our models have 4% loan growth this year going to 5%. That's not stellar. So all you need is a little bit of improvement, and you can make earnings per share start to move. And then with buyback, they've been buying back stock, it'll help even more on a per share basis.
Tom, BKX, the KBW Bank Index, up about 20% this year already, just about to pace the S&P pretty soon. But Bank of New York Mellon up 42%. Why do you think it's attractive still at this level? I believe it's the best performer in that index. It's like the Apple of bank stocks this year. So we've been recommending it
and are sticking with it, assuming we see no surprises tomorrow. But the company's earning 22% return on tangible common equity. That's a powerful level of profitability for a company that you could even argue and has excess capital.
There's more upside?
So we think there is, because I think just good fundamental performance will be rewarded by the market. And so our analysts, and again, we'll review earnings tomorrow I don't want to say a change is off the table, but as of right now, assuming we don't see anything that surprises us, our view is it's a good story that will continue to keep playing out. So we think of the big three tomorrow, Wells, JP Morgan, and Bank of New York, the fundamental play where 3/4 of the revenues are fees, not net interest income. That's the place to be right now, we think.
So we're talking broadly about big banks here, and of course we get more of them next week. Then we get the regionals, and that's when things get really exciting. And heading into regionals, you had Citi saying that now is the time to buy regional banks. They talk about recent valuation expansion, still has upside from here, despite the recent move higher off the recently mispriced liquidity and CRE credit concerns. So that's the Citi view. What is the KBW view when it comes to those smaller banks?
We would agree, and we've been saying in our research to overweight the spread lenders, which are the regional banks. They're the ones that don't have investment banking operations, for example. They're the ones who are going to benefit the most when the heat comes off deposit competition and the yield curve, presumably goes back to a more traditional shape. So that is where we think the action will be. And those stocks are typically cheaper than the BKX. The KRX, which is the other big index, is only up 2% this year. The big bank index is up 20%. So that's why we think that is likely to be where there'll be more action. And we've been recommending stocks, in that category as well. Western Alliance, Comerica, for example. Those are mid-sized, not real small, but those are the types of stocks we've been recommending.
Well, let's try to, harvest some doom and gloom here, because when it comes to CRE, it feels like we haven't been worried about that in a while. But who was it? Was it Victor Kosla who said that there's a tsunami coming for the U.S. office space? So, there's still folks out there who are still worried that there's a shoe to drop when it comes to commercial real estate.
So, a couple points. Yeah. Typically, the Fed is not consistently easing before a credit cycle's even started. So you've got the Fed in some ways coming to the rescue before a credit cycle's even started. When you look at commercial real estate, it is challenged by what's been happening, but it's been, I think, most localized, big urban centers, big coastal urban centers. If you look at Wells Fargo, Citizens, and other big banks, they have 10.5% loan loss reserves against those urban portfolios. In the global financial crisis, the losses were less. In other words, you could say they've already taken the reserves for what could be very bad. So I think the headlines, like we're going to see properties in these big cities trade for really low values relative to what somebody paid for it. It's not going to make anybody feel good, but it's the system cleansing itself in these big cities. And the question is it a problem? Of course, whoever owned the equity, it's a problem. Yes. But I don't think it's going to be a banking crisis. But then the last point on this is I'd be very specific. New York City, rent-controlled, multifamily has been the worst problem there is, and that's because rent control hasn't allowed the rates to keep up with inflation, and those properties have a systemic problem. So that's why that's why here in New York City, it sounds worse.
All right, so these are all issues that we can follow over the next few months or years, but I want to bring us back to tomorrow. We always talk about when the earnings come out, especially with the big ones, investment banking, right, and the trading operations. Do we know essentially how the investment banking has done?
Goldman said the trading would be a little less than a gangbusters last year, but curious about your view here on how...
So we've had a lot of the big banks at competitor conferences in the last couple of weeks. We've had some guidance. Our view is that year over year, broadly, investment banking up 16%, recognizing the multi-year trend we think is underway, down 14% from the second quarter, just because DCM, for example, debt capital markets, very strong in the second quarter. Our view is that there is a grind higher to what is normal. I don't believe investment banking revenues are normal today. They are still below what we think should be a typical run rate. And if you look at the M&A boutique shops, you'll see these stocks have been some of the best financial stocks in America. It's because the investors are betting on this turn coming. And what are the drivers? The election will be over. Interest rates are going lower. Stock prices are high. Credit spreads are tight. And we're getting a soft landing, not a hard landing. and private equity, like I said, a lot of pent-up demand to do things. Those are the macro factors that folks are looking at to improve the market.
Fascinating. I just took a look at Lazard stock, for example. Of course, they had a tough couple of years, but they're up 43%. That's more than Bank of New York Mellon.
There are other examples.
So on that IPO, ECM, DCM question, these are capital markets businesses, but in recent years, particularly in the last 2 years, a lot of competition from the private markets. You had Jamie Dimon, you had the CEO of Citadel Securities, both this week, kind of complaining about this idea that the IPO market is super hindered. They blame regulation, but also the private markets.
So I think it's a combination of both. I think there has been some overreaching on the regulation, which especially in Europe, it's even more so than the United States. But if you look at the regulation on being a public company, that is a headwind. At the same time, the private markets have become more efficient. So, you know, there are not enough public companies to be in some of these indices. So I think we're at a point where there needs to be a public policy discussion. Is the country better off with this? So I think you raise a good point.
Where are all the
and
deal
take a
fees,
step back.
Tom? Where are all the deal fees?
Well, that would be a side benefit that you point out. So I was just thinking about capital formation being good for the economy, but yes, would create more fees too.
Tom, great having you on the program. Fantastic ahead of the earnings tomorrow. Thanks so much for joining us.
Terrific.
Tom Michaud there of KBW. He's a CEO. Let's get a check right now on the markets and how they're doing with Abigail Doolittle. Abby, what do you see?
Yeah, well, if we take a look at the S&P 500, we do have a small decline here, down about 0.3% off of the lows. And of course, that CPI data coming in a little bit hot and then payrolls a little bit higher does create a slight bit of a risk-off flavor. You can see crude oil, on the other hand, going to the upside, up 2.3%, a bit of a break, a reprieve from the recent selling, but a haven bid both for bonds and for the U.S. dollar. You can see the 2-year yield down about 3 basis points, and the Bloomberg Dollar Index up about 0.9%. Now, if this small gain can continue, it means that we will be in this multi-day winning streak, an 8-day winning streak for the Bloomberg Dollar Index here in white, and then SOFR in blue. Kind of a look at the Fed expectations for the Fed coming up just a bit in terms of yields for next year on this economic data and the Bloomberg Dollar Index following. This is the longest winning streak going back to 2022. And then for a few individual movers beneath the surface of the S&P 500, we will take a look at Celsius up 11.3%, a pretty solid quarter there. Amazon up 0.7%. They're saying it was their best October selling event ever. More people shopped this year than last year. Delta down 1.5%, a disappointing view, having to do with that third quarter technology issue weighing on the entire space. And then Tesla off the lows, down 0.9%. This, of course, ahead of the unveil of the robo-taxi. Some analysts, Katie, are saying that it's really important that this fully self-autonomous driving vehicle from Tesla, that it's going to meet the mark, given the fact that the valuation of Tesla well ahead of Ford and GM.
All right, the stakes are high for Tesla. Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, a story about how competition shapes innovation. Bank of America's senior aerospace and defense analyst Ron Epstein discusses the evolution of space travel. This is Bloomberg.
Crew 9, go SpaceX, go Falcon, go NASA.
Liftoff of Crew 9 now soaring to the International Space Station.
This is 1 Alpha. Stage 1, full terminal. Copy, 1 Alpha.
All right, it's time for our daily Wall Street Week conversation. And after NASA retired its space shuttle, the competition opened for companies to bring astronauts back to space. David Weston speaks with Bank of America's Securities senior aerospace and defense analyst Ron Epstein about how SpaceX and other businesses are changing the industry.
We're seeing a big shift. And I think a lot of it has to do with evolution in technology and availability of capital. Space markets up until SpaceX were the purview of governments. You saw that all through the space programs in the U.S., but globally too. I mean, it's always been the purview of governments. SpaceX was really the first company to say, hey, you know what, we're going to try to do this, and they did it, and they offer space as a service, which is really fascinating, right? If you think about what the Air Force does. The Air Force used to buy rockets and launch them. Now what they do is they buy space on a Falcon 9 and put things in orbit. They don't own the rocket, SpaceX does. So space as a service has come a long way. But when you think about commercial markets for space, it's not just launch. That's launch, but there's Earth observation, data from space. So there's a whole space, if you will, economic infrastructure. And that's evolving too. And I think one of the reasons you're seeing this happen now is because of the commercialization of launch, that's enabled companies to pursue business models that they might not have otherwise been able to before, when it was really just governments doing it. And the commercialization of launch has also driven down launch costs. So realistically, if a high school class somewhere raised some money, they could launch and put something on a satellite in orbit and do an experiment. And that, outside of something being, a very government-sponsored program, that would have been impossible before, but now it's not. So you're seeing this in some ways a democratization of space business models, and that's how things are changing. Some work, some don't, but you have this flexibility now where you can try things that you wouldn't have dreamed of before. So there's companies, like Planet Lab, as an example. Planet Labs, they have developed a series of satellites called Doves, and the Dove satellite is about the size of a loaf of Wonder Bread. Quite literally, it's very, very small. When it puts out its solar panels, it's a little bigger, but the actual satellite's quite small. Hundreds of them in orbit, observing the Earth all the time. And now that's something that wouldn't have happened before. And that's created sort of a democratization of Earth observation data. And then the second question becomes who uses that data, how's the business working, so on and so forth. But it's really the change in technology that enabled commercial launch to happen. And it's not just SpaceX anymore. You have, SpaceX is doing it and they're very successful at it, but you have a company called Rocket Lab. They have now a nice legacy, over 50 launches of their own launch vehicle, called the Electron, bringing things into orbit, and they're working on another launch vehicle. So I think that's what's really caused it.
And that was Ron Epstein of Bank of America Securities speaking to David Weston. Of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Republican presidential nominee Donald Trump revealing his latest pitch to voters. Trump saying he would end U.S. income taxes on Americans living abroad. That is his latest proposal as he enters the final stretch of the campaign. And joining us now to discuss is David Gura. He is host of Bloomberg's Big Take podcast. And I know that Matt is sitting to my right, and he says, about time. Walk us through this pitch.
Well, he's made it via his social media site, so we don't have a huge amount of detail on this yet. Truth Social, indeed. But a lot of Americans who live abroad who make over a certain amount of money, I think the threshold's like $125,000, are taxed twice. There's double taxation. So he's proposing getting rid of that. I think there are 9 million American citizens who live overseas. So this is a voting bloc of a sort. And they vote. Many of them vote. So it's a voting bloc of a sort, but I think it goes to this kind of broader strategy he has of finding niche populations and catering policy toward them. Of course, this is something that would have to be approved by members of Congress. So who knows if that would happen and how much of a difference it would make and how much it would add to the deficit.
Now, I've got an issue here in that, on the one hand, Donald Trump is speaking to me, right? He's going to get rid of the SALT deduction cap.
That he put in place.
Yes. He's going to stop the double taxation of Americans working abroad. He's going to keep tax rates low. On the other hand, he's just randomly making stuff up all the time, right? So can voters believe he's going to do what he says if he, pretends that Haitians are eating cats and dogs and that FEMA is giving its money away to Mexican immigrants?
Well, it feels scattershot, and it does feel like he's making these tailored policy proposals when he's in certain places. So the one, no taxing tips he made when he was out in Las Vegas, when he was in Nevada. So he's clearly catering to I mean, I think the broader takeaway I'd like to offer is that there isn't a whole lot to back these up, not just in terms of like what the policies are like, but how he would pay for them as well. Would they come to pass? And going back to what Congress would have to do,
But that's a different conversation, right?
Maybe
he would pay for them in that revenue would rise, the economy would grow, right? If you cut my taxes, I'm just going to spend that money into the economy anyway.
There's also tariffs, which he says will pay for things.
Everybody is talking about the Committee for a Responsible Budget report this week, the idea that he would add $7.5 trillion to the debt load over the next decade. Kamala Harris would have to. Either way you go, it doesn't kind of fix the problem here. How are either of these candidates going to cut any taxes, frankly?
Well, to your point about the size of the nation's debt deficit, it's just not being tackled. And I think that, like, when I lived in Washington, when I was covering Washington, there was a huge conversation surrounding that. There were a lot of deficit hawks. They've kind of flown the roost, I guess.
Well, who cares? 10-year yields at 4%.
They're not paying attention to it, and it's not an issue anymore.
Can Congress cut taxes at all?
They're going to have to decide what to do with the Trump tax cuts. That's the kind of paramount issue that they have on their plate going forward here. So it's not going to be kind of a new brand of implementation, but they're going to have to think about what to do with that as they come back to session after the election.
Before we, go ahead.
Well, I was just going to say really quickly, David, we should also talk, of course, about the hurricane. Sure. Hurricane Milton touching down in Florida overnight. What has the response from the administration been? And, of course, what has the response from Governor Ron DeSantis been?
So we heard from the governor this morning. President Biden is having a briefing with FEMA and the Homeland Security team this morning, just a few minutes in Washington. Vice President Harris is in Arizona today for a campaign event. She's going to participate in that virtually, the White House says. They're trying to show kind of constant engagement with this issue, as they did yesterday. There were a couple of briefings. That's going to continue. And then we heard the governor of Florida this morning telling Floridians not to leave their homes, be safe, as they kind of assess the damage. He said this wasn't kind of the worst case scenario that many of them feared, but certainly a lot of devastation. We're just beginning to get a glimpse and sense of sort of how big that is.
All right, David Gura, always great to see you. That is David Gura. You can listen to the Big Take podcast wherever you get your podcasts. Meanwhile, a quick check on these markets, of course. Still a down day. You can see on the S&P 500, down about 3 to 0.4%. Same thing if you take a look at the NASDAQ 100. The 10-year Treasury yield a little bit higher, of course. CPI coming in hotter than expected this morning. Your 10-year Treasury yield currently trading at about 4.09%.
And we have a lot more coming up on Open Interest as well. Of course, tomorrow we have Brett Keller, the Priceline CEO, joining us in the C-suite. We also have bank earnings, of course, as well. We kick off the season here on Bloomberg Open Interest. Stick with us through the end of the week. This is Bloomberg.